Hey Bowtie Nation, Joseph Hogue here with a different kind of video for you today. I was invited to New York recently to participate in the NASDAQ bell ringing ceremony with the launch of a new GraniteShares ETF. As part of that trip, I sat down with CEO Will Rhind to talk about my 2025 outlook. So I wanted to share that conversation with you here, along with some additional thoughts to get you ready to invest in 2025, including what could be a significant pullback in the first months of the year, along with the stocks I'm watching.
This is Will Rhind from GraniteShares. I am here at the NASDAQ in New York City, and today we are here to celebrate the launch of the GraniteShares Yield Boost Tesla, the Yield Boost family of ETFs, TSYY. And it's my pleasure today to be joined by Joseph Hogue. And we are talking here at the NASDAQ with some of the top investors and advisors here in the country. And we've been talking about different investment themes, but let's start with 2024. And in your mind, what are some of the things that have worked well this year for you?
Sure. Well, I think we were all surprised at the level of capital expending to AI and just the exuberance it's created, right? The market never sees these things coming. But what I think you can do is be ahead of the next wave or the next iteration in that theme. Going into, we've already seen the data center solutions, server solutions with HPQ, with Dell Technologies, and with Supermicro really getting bid up. The next iteration could be connectivity, networking, which really could be the next bottleneck in that AI theme and the delivery theme. So we're looking for things like Arista networks.
Okay, so I'm not sure that really even answered his question of what worked in 2024, but then what worked last year might not work this year. So I want to focus on how to invest in 2025 here. This last year, we highlighted stocks like SoFi Technologies, ticker SOFI, up 54% for the year and up 164% since I started buying in 2023. We've also seen other AI stocks like SoundHound AI and Palantir jump, both up more than 164% from highlighting them on the channel. And now that AI theme clearly has room to keep running, but you never want to be reacting to the market, buying last year's stocks. The best returns are always going to be from that proactive approach, so thinking through that next wave and where the market is going to go from here in that server build-out, networking and connectivity, and then the AI benefits across the broader economy. Again, here I think networking and connectivity stocks like that Arista Networks, ticker ANET, which is already up 90% this year, but also a sleeper pick in Cisco Systems, ticker CSCO, which has lagged the market and could have some hidden value.
Looks like, obviously, we're now in the Fed easing cycle here. Interest rates have come down a little bit from the high. Inflation also looks like it's under control. What are your thoughts in terms of market outlook for 2025?
Sure. 2025, it looks like the bull market still has legs. Now, there is a problem there. Stocks are undeniably expensive. I think analysts are falling over themselves trying to increase their targets. The average now is 6,600, which would be about a 9% upside for the year. But if you look at historical evidence, FactSet, last 20 years, analysts have, at the beginning of the year, overestimated the ending value by about 9%. Or 7%. So that would put us right around a 2% increase over the year. So pretty underwhelming considering the last 2 years have been 20% plus returns, but we still have that recipe for a bull market. We have the deregulation, the potential for lower taxes, the Fed liquidity, the Fed rate cuts, even at a slower pace. We're now expecting just 3 cuts next year rather than 6, where we were just a few months ago. And but the problem is with the timing here is I think you see with the agenda, the administration's agenda is that some of the negatives for the market, the tariffs, the deportations, are easier to pass with an executive order. So those could come, be front loaded in the administration, whereas some of the market positives, the deregulation, the potential for lower taxes, have to have congressional action. So that's going to come later. So for 2025, I'm expecting some kind of a sell-off, maybe even a correction in that first quarter as we come off of these very much nosebleed valuations. But then those valuations bring the bulls back. And we do have that recipe for a bull market that extends into next year and even beyond.
Now, there is a lot to unpack here. First, that recipe for a bull market that I talked about, and maybe the best advice you take away from this video. Folks, stocks are undeniably expensive here, with a major index, the S&P 500, trading for a price of almost 24 times the earnings companies in the index have already reported, that PE ratio. You can see here in this chart by Yardeni Research, other than briefly post-pandemic when the government was just shoveling money into the system, or in the lead up to that dot-com bubble, stocks haven't been this expensive in more than 40 years. But then against that, all the pieces are there to support stocks into 2025, that recipe for the bull market that I talk about in the interview. I like to use this triangle model by Quinn and Turner because it's a very simple way to just analyze that big economic picture that's driving a bull market or even a stock bubble. Here you need three things to keep that market running higher. One is speculation, which is this kind of investor sentiment, that exuberance investors have for stocks, which is still very strong. You also need that marketability, which is the factor that makes it easier for people to buy or sell an investment. We've seen this over the last few years with fractional shares and zero-cost investing, but also some new developments that are really boosting that marketability. First is the SEC ruling to allow half-penny quotes just this September. That could lower trading costs by narrowing the bid-ask spread between stocks and saving investors money and increasing volume. Here also the potential deregulation from the incoming Trump administration would also support that marketability idea. We've also seen a wave of increased marketability through new ETF products like single stock leveraged funds and derivatives-based income ETFs, all really increasing the opportunities for investors and that marketability side of the triangle. And the most important side, though, is then this money and credit, the fuel that keeps that market fire burning. And here we have two charts that will blow your mind if you think about them. First, the level of homeowners' equity in residential real estate, now at almost $32 trillion, and more importantly, up $12 trillion just in the last 4 years. And we know that homeowners love to cash out that equity to buy stocks and for other spending, but haven't been able to because of high mortgage rates over the last 3 years. With the Fed now lowering interest rates, we could see some of that home equity gradually unlocked and start boosting the market even further. There's also another $6.8 trillion in cash locked away in the money market accounts, up $1.6 trillion just since the pandemic. Now, people are sitting on those money market accounts while those rates are high, but as the Fed lowers rates, the return is going to start looking less attractive, and some of that money will flow through to higher yielding investments in stocks. Now, also boosting that money and credit factor is just the Fed's rate cuts themselves. The central bank has cut rates a full % this year and is expected to cut another 2 times next year. That's fewer cuts than the market was hoping for just a couple of months ago, but it still means lower interest rates, lower cost of doing business, and a support for stocks. So what we have, even though stocks are expensive, is an environment that is very supportive of the bull market. That bull market continuing to charge, though, doesn't mean that we won't see a correction, a short pullback around 10%, and this is what I'm talking about in the interview. These quick profit-taking pullbacks happen nearly every year, every 1.2 years on average, as stocks get expensive and investors just get skittish. And to that, we have considerable headline risk to the uncertainty and the negative aspects around some of President Trump's proposals, like deportations, which would hit employment in a few key industries, and then tariffs that could increase inflation. As I mentioned in the video, these are easier to pass with those executive orders than the deregulation and the tax cuts. So as the new administration takes over and starts talking up its policy, the market could get scared off on which is going to come first. That pushes us into a correction, even if that longer-term forces support the bull market, and I'm holding some cash and bonds to invest on those lower prices when we do get that correction.
So talking about one of the other top themes is income or yield generation, and part of that is due to rates starting to come down again, but part of it may also be due to what you just said, which is some of the valuations at the market. People may be prioritizing income generation as opposed to chasing growth. What are your thoughts in terms of yield or income market, dividend investing more broadly?
I think actually just the converse. I think a lot of dividend investors have seen those amazing returns for Tesla, for Palantir, and have been a little frustrated at their safe dividend stocks paying out even the 6% yields, maybe growing, maybe adding another 5 or 6% return on that a year, but then seeing all their friends get rich on those growth stocks. So I think they've been pulled into first the higher dividend names, then other products that can boost that yield.
This is kind of a tragic theme over the past couple of years because nobody likes dividend investing right now. I've seen it myself in the statistics on videos where a dividend video in the past would have done really well, but so many dividend investors have just given it up, switching more of their portfolio into growth stocks. There is still an important place in your portfolio for those dividend-paying stocks, though, because when that correction does come, or even eventually a crash, dividend stocks are going to provide that safety and the cash flow for that opportunity buying. Now, over long periods, dividends are a big part of the total market return. This table by Guinness Global shows the percentage of total market return from dividends in each decade, and you can see in some of those rough decades with big crashes, dividends were most or even all of what you could expect. Neglecting dividend stocks altogether would have left you considerably worse off.
Well, Joseph, this is the High Conviction podcast, as you know, and what we always like to ask our guests to finish up here is, what is your highest conviction trade or investment idea for next year?
Sure. Well, I think the highest conviction is probably the most unconventional. We've seen a sell-off in the Medicare insurers over the last really 4 years as the prior administration really restricted what they could market and other terms, trying to move people back into traditional government Medicare. We saw a big bump in the group post-election, the day after the election, but a lot of those have come back down to where they were before the election. You've got President-elect Trump, as well as his CMS nominee, Dr. Oz, have both cheerleaded Medicare Advantage. In fact, in his Senate campaign, Dr. Oz had made one of his goals a expanded access to private insurer programs. So you've got that headline risk to the upside for these. You've got names like, I think, United Healthcare, UNH, and Humana, HUM, are almost 50% of the Medicare Advantage private insurer market. 29% for United Health and 18% for Humana. Humana is actually down 48% this year, the sixth worst stock in the S&P 500. So trading at very attractive valuations, just 13 times on a price to forward basis. So I think if you are worried about some kind of a pullback in the growth stocks and in the rest of the market, here you've got a part of the market in these Medicare Advantage insurers that is already very attractively priced, has limited downside, but then that upside to headlines that could be coming out, fairly early in the administration.
I published a full video about this last week that I'll link to in the description below. But again, this could be one of the biggest surprises for 2025. And besides that upside return, it could also help protect your portfolio from that correction or a crash. These Medicare Advantage stocks are already trading at very attractive valuations and a clear policy upside into the new administration. In that theme, I'm watching United Healthcare, ticker UNH, and CVS Health, which has multiple levers to unlock that value, but really it's Humana, ticker HUM, could beat them both. And I recently invested $85,000 on the shares ahead of that 2025 potential. And those of you out there in the nation also know my other favorite themes I'm watching include cybersecurity stocks and fintech companies. I'm buying Zscaler, Palo Alto Networks, and CrowdStrike on that ever-increasing demand for cybersecurity protection. And while SoFi Technologies has been my best investment over the last couple of years, it's getting a little pricey lately, so I'm now shifting some of that money into Ally Financial, a fintech trading at much more attractive valuations.
So we talked about AI just there. How far along are we, do you think, in the AI trade? Are you in the fourth industrial revolution camp? Are you in the fad camp? Where do you sit on the AI debate?
I think very much in the fourth industrial revolution, and it will be very exciting, but I think there will be that disappointment on the way. And it strikes me as a very close comparison with the dot-com boom, right? We saw all these internet stocks come up in the late 90s, of course, sold off or even ceased to exist there in 2000. But nonetheless, that theme, that internet theme came back and really did boost productivity, really did boost the economy and changed our lives. So I think that's a lot of what we're going to see with AI now. We're still very much in the early innings of seeing it actually boost productivity, actually be applied to use cases. There are a lot of use cases in marketing, how that's led to productivity gains in those firms. But generally, as far as the wider economy, it's really a non-event so far. So I think we are going to get to that point where all this capital spending going to that is going to be disappointing in the ultimate earnings that it brings in. We're going to have that bust, that crash, that sell-off, and then eventually a lot of those names are going to be the next Amazon that since 2001, since that low of 2002, has gone on to 5,000% return.
As I said here, the last 2 years with the AI theme has been eerily similar to the dot-com market of the late 90s when I was just starting to invest. There we saw a massive wave of funding and investor enthusiasm for this new technology and the promise it's going to change our lives. And we see here just the top four big names, Amazon, Meta, Alphabet, and Microsoft, invested nearly $53 billion into AI in just the last 3 months alone. And you always know spending is getting out of control when people start saying things like Alphabet's CEO saying the risk of underinvesting is dramatically greater than the risk of underinvesting. Now, the problem was in the 90s, as it will be this time around, is the market just gets ahead of itself and has no patience for those changes. Sequoia Capital estimates that just to justify this year's investment in AI-enabled data centers, artificial intelligence would have to drive $600 billion in revenues, with analysts estimating that current revenue generation is closer to 10 or 20 billion. Now, against this, we're already seeing the AI models slow down in terms of how fast they're learning, with costs still increasing exponentially. So what happens, like it did in the 2000 bust, is the market just gets impatient for that giant productivity changes to appear. Earnings growth doesn't jump to justify the spending, and even a slight change in some of these factors that go into that bubble triangle model that we looked at earlier, maybe you lose the investor sentiment that drives that speculation. Maybe the Fed reverses its interest rate cuts in the face of stickier inflation, or just any government policy changes. Now, when that happens, and it's probably not for at least another year, but when it does, that bubble is going to burst. But nation, it might not seem like it at the time, but that is going to be the best opportunity of your life to pick up some of these shares of AI names after that crash. Like the internet revolution, this technology is going to change our lives, and the stocks you pick up when everyone is selling is going to be the best returns you ever see. Don't miss our 2025 investing series. Click on the video to the right for the 5 stocks to buy in my $100,000 club. Stocks I've made over $640,000 on, with more on the way. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.